Good morning, everybody, and welcome back to Spotlight on Business by GTApreneurs. I have the pleasure of introducing to you today, John Lysack. John is so amazing as a professional, but also he is Professional of the Week for GTApreneurs Downtown Network. All the group members are so happy to have him. He always goes above and beyond, and he's someone that you definitely want to be helping you out with your life and all of your goals. So let's learn more about John and what he does. So welcome to the show, John. How are you today?
Hi, Tammy. I'm happy to be here. I'm doing great. Thank you for asking. How's your week been?
Week's been great, and so much looking forward to introducing you to everybody. So,
Good.
How about you tell us more about yourself and what do you do?
Yeah, absolutely. So my name's John Lysack. I'm associated with Freedom 55 Financial. I've been in the industry for I think about 5 years now. And I did some volunteering within the industry at Advocates, which is a financial organization that helps with regulatory decisions for the government. So I volunteered on that for a couple of years before joining the industry. And I got a dog named Disney who loves chasing birds.
All right, gotta love that, right? Mm-hmm. That's so cute. What kind of dog is he?
A Maltese Pomeranian.
And so why did you get into being a financial advisor?
Yeah, thank you. The reason I got into financial advising was growing up. By the time I was 18 years old, my parents declared bankruptcy collectively 3 times. And it was a pretty unique experience. And, just like we all do around 18 years old, we start to, take a look at our own finances and help with our own take a look at our cash flow needs. And we always turn towards our parents because there isn't enough education in school. So, I turned towards my parents. They provided me with some advice, but eventually some of the bad behaviors that they had were starting to pass down towards me. So I started to look for my own financial advisor. He took the time to educate me on a variety of different things and eventually made me feel confident in my own financial situation. And once I started feeling more confident, I started sharing my experience with other people. They started opening up to me a little bit, and I realized that my situation wasn't as unique as I once thought, and that there was a great opportunity to help a lot of people.
That's great. And I know that being an entrepreneur, myself and yourself, that we do tend to have a little bit different needs than employees. So can you tell us a little bit more about the difference when you have those different types of clients?
Yeah, absolutely. The biggest thing there is when, as an employee, you get a lot of different benefits. And I think that can be sometimes taken for granted, especially if you're thinking about moving it over to the entrepreneur side. As a salaried employee, you get EI protection, which is employment insurance. Your employer pays for half of your Canadian pensions. You have a health and group benefits as well that your employer will often pay for. And when you're an entrepreneur, you're really responsible for all those additional expenses. And the biggest thing is without your health, you have no wealth. So you want to make sure that you have a good health plan in place, which you have to look for on the insurance market to find a health plan that meets you and your family's needs. And that can be either individual or group, depending on the size of your business.
Great. Yeah. And so, for companies, there's some companies that don't have health and dental though, right? And so what is the advantage of a company who may be thinking about getting their own health and dental plan for their employees versus their employees looking to get insurance on their own?
Yep. No, very, very good question. So group benefits for a company can be really beneficial as there is some additional value that you can give to your employees. So, for example, if your employees are asking for a raise, it might be better to explore a group benefits plan instead, because a wage with CPP, EI, and all those other expenses, it tends to be 20% higher. So you give your employee $1, it costs you $1.20. So with a group benefits plan, you can attach a particular value and give all your employees a little bit better health package, which is 100% tax deductible. So there's no additional cost with that. And employees tend to find a great value in RRSP matching plans, pension plans, as well as the health benefit plan.
That's great, and I know there's so much detail in terms of the benefits of group RSP and a group and that sort of thing, right? And so, but I just wanted people to know that you do offer those services. So if someone's a small business and they do want to grow, you said instead of just, paying people a higher wage and they have to pay extra EI and CPP and everything on top of that, getting the health and dental benefits, when employees have that, and maybe they won't take as much time off work for a sore back because they can go see a massage therapist, right?
Yeah, exactly.
Right. Yeah. And not only that, sometimes when people are trying to apply for their own independent health and dental benefits, that they can get turned down, right? If they have pre-existing conditions, but if they're part of the group plan, then they don't assess medical for each person individually.
Yep. No,
right?
That's a valid point as well. Exactly.
Yeah. And so if you're an entrepreneur, so what is the minimum number of employees an entrepreneur needs to have in their own business to qualify for their own group benefit plan?
For their own, to get your own health benefit plan, all you need is one employee. So there's an individual health plan that you can do, which are still 100% tax deductible. But when it comes to a group plan, the minimum is 2 employees.
Nice. Great. Yeah. So if anyone here, right, if you have, as an entrepreneur, you have your own pre-existing conditions, you can't get approved on your own, you have 2 employees and you can get your own health and dental, right, which is amazing. Now, for people who are employees, though, there is some issues that they don't think about, right? So with the insurance, because they get disability, they get life insurance and stuff like that. So can you tell us the issue and maybe some misconceptions around the coverage they do have?
Yep, absolutely. That's another valid question, as they are. A lot of people hold on to their group benefits when I often meet with them. We say, do you have group benefits? Yes, that's really good. And I say, great. Can you tell me the details? And then sometimes they don't know the full details of their package. So they often think their life insurance, part of their group benefits plan, is higher than what it normally is. So which can often be as low as $25,000 to, I think the highest would be about 3 times your salary that I've seen. So it's not a lot. And then when it comes to your disability insurance, it's often, in most cases, there's a different definition for each disability. So for example, when you first get disabled or you're unable to do your work, you start off at a regular occupation for 2 years. So that means if you can't do your regular job, then you will get a collective disability benefit for the next 2 years. After that 2-year period, the definition moves to any occupation, which means that if your body's still able to work, it is expected that you will do so, and it will be to a particular task that you are qualified to do. So, if you can get up and push a broom, you can expect that you'll be going back to work.
Right, exactly. So even if you're a dentist before, right, and you can't do like the fine motor skills, if you can push a mop or something, or you can be a greeter at Walmart, well, you know what? Sorry, we're not paying you disability anymore. Yeah,
exactly. Usually it's based on what you're qualified to do within your expected salary. But if you're able to stand and do those types of activities, you will be going. The insurance company would be expecting you to go back to work. But yeah, that's exactly the point.
Yeah, and I worked with this lady one time, right? And I mentioned that, I know someone who does insurance and stuff like that, right? Has she looked into getting more life insurance? She's like, oh, well, that's okay. I have it through my bank or my spouse has it. So, if he dies, then I'll be fine, and it's a certain amount. But, a couple issues with that, right? First of all, what if one of them loses their jobs, right? Then no more insurance, right?
Yeah.
And the other thing as well was that because if you're only getting, a $25,000 to $100,000, $150,000 in your insurance, and let's say your mortgage is $400,000, even if you put that on there, the surviving spouse has to qualify for the mortgage on their own, right? The bank is going to not just pretend that it's still the 2 of you, and you're going to keep making your monthly payments. The remaining spouse has to still qualify. That remaining spouse is not working or their income is low. Even let's say with $150,000 in life insurance you put in there, the surviving spouse may not qualify. They might actually have to sell the house, right? Whereas compared to if you give them your own policy, then, and they can get like, let's get, 500,000, million, whatever they want to get, then they can, be assured, they can feel safe that, they will never have to sell their home. Like it'll be secure. They can pay for that. They can pay for, their children's education and stuff like that.
Yep. No, that's true. And there's and that's a little bit more what we do as well is we have a saying, it's either you have insurance or you have an insurance plan. And for a lot of people, they have insurance. And what that means is that they have, their group benefits plan, or maybe they have a small policy, and would they just know that they have it, and if it comes in. But what we do is we take it a little extra step further, and we'll say, okay, so you need this much, X amount to cover your mortgage, all your debt, to make sure that your spouse is going to be okay. And if you have any children, then we add in an income replacement plan where we use our detailed calculations, but essentially you will be able to get let's just say $40,000 a year from your spouse for the next 20 years to make sure that your child will have the best lifestyle possible. And that's sort of an example of having insurance versus having an insurance plan.
Now, another thing that people often get, they go to get a mortgage and they're like, oh, you should get mortgage insurance, right? But there's a lot of misconceptions out there about mortgage insurance. So can you tell us the difference between getting that and getting your own life insurance policy?
Yep, absolutely. So with a mortgage life insurance, it's also known as creditor insurance. So if you do like a search on Google for creditor insurance, you'll find a variety of different examples of how it is a little misleading. CBC Marketplace did an excellent, comparison of what it is, and so I would recommend checking that out. But at the end of the day, mortgage life insurance covers you. You answer 6 questions, and it's all listed in one really big line. And it's one of the example that I helped one of my clients was, it said, have you had any stomach or gastro issues? And he experienced a little bit of that. He recently went to the doctor for that, and by that, because he just went to the doctor for a little bit of diarrhea, theoretically he was no longer insurable because he sought treatment for gastro. So it's a very misleading conception. So, and if you were to make a claim, so at that time he was actually theoretically not qualified. So if something were to happen to him, then the insurance company would go back and review his file and find that he went to the doctor for that issue, which resulted into the insurance not being claimed. With a personal insurance plan, you do all the questionnaires up front, and it's often very detailed. And a qualified professional is often asking you these questions to help you explain what exactly they're looking for. And you get all the information up front. And you get an actual contract that goes with your life insurance policy. So it provides you with certainty that policy is in place, which would provide you with the benefit, even if your health were to change down the road. And then once you renew or refinance your mortgage, you actually have to requalify every time you do that. So if you're refinancing your home every 2-3 years, you really risk that, you're really risking your home by doing that. And you want to just make sure you have the right insurance in place over the long term. And frankly, it's more expensive than traditional insurance or your own insurance over the long run.
That's a great point. A lot of people don't think about that. If you have to, every time you reapply, you have to requalify. So maybe, when you first got your mortgage, you're all healthy, right? But as we get older, right, and different things creep up and stuff like that. For example, maybe you have high blood pressure now, right? So I think that's maybe one of the things that they look at. Can they disqualify you for that?
Yeah, that is definitely on the questionnaire that they ask, and that you would definitely be disqualified for that.
Right. So, but if you get your life insurance policy, once you get that, then that's good for your whole life. They never re-ask you again if you have high blood pressure, high cholesterol, whatever. So it's one of these things that, the sooner you can get, the better.
Correct. And with your own insurance policy as well, the questionnaires, the insurance company really wants to give you insurance. Like that's what they're in the business to do, and they really want to give it to you. So sometimes even if you do have a little bit of health issues, it is good to still speak to a professional and get an assessment done, because sometimes the insurance company will still give you insurance. They just might charge you a little bit more for, some of the health issues that you may have experienced. But the point is that you would still have insurance compared to the mortgage insurance, where it's an instant decline.
For sure. The other thing as well is that for post-claim underwriting, can you tell people what that means compared to, pre-claim underwriting?
Yeah, absolutely. So post-claim underwriting is when you got like mortgage insurance, you ask the questions, then when you make a claim, then the insurance company will look into your file to make sure that you actually qualified. So it leaves the person insured or the client under the impression that they have been, they have mortgage insurance, they have life insurance in place, but it's actually not in place until the insurance company looks at it at the time of claim. So you're always taking a little bit of a gamble. With life insurance, as I said, you answer all a detailed questionnaire up front, and then you get actually approved, and you actually have your policies in place. Did I explain that okay?
Yeah, exactly. Right. And so some things I've heard of, some cases where, there was a spouse died and stuff like that. Then the other spouse went to make the claim on the mortgage insurance, and they say, well, in the questionnaire, you said that you've never been tested for hypertension. You've never been tested for cancer. But if you're a woman, you've had a pap test before, or you've had a prostate exam before, you've been tested for cancer, right? Doesn't mean that you didn't have that, you had it, right? And they will decline you.
Yeah.
Right.
Yeah.
So, and I heard 80% of claims on mortgage insurance are denied.
It is quite high. So if you know anybody that has a successful story with that, it's a very great situation for them. But I don't have the exact details in front, but yeah, the decline rate is very high.
And then, so the thing is that people are paying all this extra money with their mortgage payment every month for years even, and then they make a claim, and then they're like, well, sorry, you don't qualify.
Mm-hmm. And you've paid into it, for all those years, and it's quite difficult, right? So, so it's always good to speak with a professional about your life insurance to kind of walk you through the full process, which I've, done lots of time providing those initial assessments to make sure that you're, to find you the best possible rates, as I am a broker.
Right. Broker. Yeah, that's important. Right. And so that's one side of what you do, right? Is to make sure that people are protected. So if something happens to you or your spouse, your family, even if it's something happened with your child, unfortunately, that, you probably want to take time off work. You also want to have something for your own expenses, right? So people don't think about getting insurance on their children, but if the children get sick or, passes away, unfortunately, that there's also something good to have in place. But so now that we would have all these protections in place for us, but we still have goals, right? So what are some other goals that you help your clients with?
Yep. So other goals that we do is we do goal-based. We have a goal-based planning approach. So essentially what we do is we build a financial plan, and a financial plan is a comprehensive picture of your current finances, your financial goals and strategies that you want to achieve. Good financial planning should include debt, cash flow, as well as investments in insurance and other elements. So, that's a detailed version, but, in simple terms, it's a goal. We do goal-based planning. So what we do is we help people establish their financial goals. And that can be some common examples are retirement, child's education, as well as, purchasing your first home, or maybe just saving up for a really big vacation. And what we want to do is we want to take a look at all those different elements to make sure that your money's working effectively to help you achieve your goal in the quickest way possible. And that's often the use of investments and other tax planning strategies.
Interesting, right? And so what's the difference between going to see you as an advisor for people to reach these goals? These basically they're wealth creation goals, right? That you need money to do this stuff for your lifestyle and stuff like that, for retirement, for everything else. And what's the difference between going to see you or going to see the advisor at the bank?
Yep, very good. So the advisor at the bank is an employee for the bank. So they are, working underneath the bank's agenda, and they have a very limited scope of what they can do. So your bank cannot offer you insurance. They can offer you the credit insurance, but they can, as we said, that's not a good product, but they can't offer you insurance. They can offer you tax savings accounts and RSPs, but they don't have the tools to and the time to, because they have a lot of different clients, and you're essentially just a number to the bank to take the time to go through with you and walk you through those steps. So an example would be, if I were to meet with you and you say I want to save towards retirement, we would, do an intense version, intense question. Not intense, but we take the time to actually understand your situation in more depth, understand your cash flow, your debt, and I can actually show you after that meeting, provide you with some recommendations on where you are today and and with some recommendations and some changes, how soon or quicker you can reach that goal. I have a variety of different tools. As I said, I'm a broker, so I'm not just limited to one line of investment solutions or one line of insurance solutions. We have a variety of different options to choose from. But I think the most important thing is that we take the time to meet with our clients, understand what their pain points are, what their goals, because everybody's unique, and you should have a plan that's unique to you.
Right. So that personal relationship that you have with your clients, right? And I mean, I know that I've, been a bank customer, right? And then one day you see one person, the next day you see another person, right? Whereas, yourself, that, you're looking to make those long-term relationships with your clients throughout their whole lifetime, right? So you take a personal interest in, helping them be successful.
Yep. Yeah, that's I'm very vested in my clients, and I like to say that I really enjoy taking meetings with my clients, and it's very important that we have that personal relationship, because there are some times where I have to take time away from my own family to go and meet with clients, which I want to make sure that I'm happy to do. So the most important thing to be my client is you got to be a good person. You got to be nice and friendly, because we're all making accommodations to our schedule to meet with each other, and we want to make sure it's a pleasure experience. Yeah.
So how do you help a person to make sure that they're going to have enough money in retirement? So
so there's a couple examples there that I have. One, it's when we're taking a look at that, we want to figure out what your expenses are. So we review your cash flow. So we want to make sure that you're able to maintain your current lifestyle for the next 20, 30 years when you have literally no income. So you're not earning any more money, right? So we need to save up X amount of dollars to make sure that is sustained for 20 to 30 years. So we take a look at your expenses, we get an understanding of what your lifestyle, hobbies, things like that. And then that's our benchmark. And then what we'll do is we'll look at how much you're currently saving and putting away. And it will, we run our figures and tests to make sure that, if that is sufficient or not sufficient. And if it's not sufficient, then we would take a look at that cash flow structure. And maybe there's opportunity to maybe invest more into your RSPs, but instead of spending your tax refund, we take that money and reinvest it. And that will provide you with, additional savings to help you reach your retirement goals. So that's one of the main things that we do. So an example that I helped somebody was they were invested in a GIC. They were close to retirement, and they were making regular contributions into these guaranteed GICs, which often provides a very low interest rate return. So what we did is we did an investment analysis. We found out that she was able to take a little bit more investment risk than what she was currently taking. So we built a different portfolio to get her a little bit more higher returns, which provided her with thousands of dollars more in retirement to increase her lifestyle and take a few extra trips. So that was one example that we're able to help. Another example was there was a client who had restriction on cash flow, some children, and he recognized that saving for retirement was really important, but he couldn't find any money to save. So we took a look and we found out that his mortgage was his interest rate was high on his mortgage compared to what was being offered on today's market. And so what we did was we had him refinance his mortgage, which brought his payments down significantly. I think we got it down to about 50% lower than what they actually are now. So that gave them an extra, $1,000 a month to start putting towards away for retirement, which, got them significantly on track. And I think we still had his mortgage being paid off around 66. So, that was a really positive situation where we're able to lower payments, increase cash flow, but still have the home paid off for in retirement.
Yeah, another thing as well, I think that people don't think about, and the bank's not knocking on their door to say, hey, you're paying all this interest in for your car loan and for your unsecured line of credit and that, but sometimes people may be able to refinance, and even with a penalty, save money with interest, right? Like kind of consolidate that debt, like pay it off by using the equity in your home, right?
Yep, and it's all about the effective use of your money, right? Like what is your mortgage? A simple calculation that you can do is what is your credit card payment compared to what your mortgage payment is, right? Like if you put that money in there, you're saving 18% on interest. So that's you got to take that into consideration, and that can really show some extra value and free up cash flow if you have a high credit card debt. Even your car loan, right? That can be put into their line of credits, things like that. It's a great tool that I think people should take a look at, especially in today's environment where if they feel like they have restricted cash flow, it might be a good time to review their mortgage insurance, review and refinance their mortgage.
Yeah, and that's the difference, between you and going to the bank is that you're going to take that deep dive into their finances, right? It's not just about here, let's give you more credit, let's give you more money so you can pay us more interest, right? It's about let me do what's in your best interest, right? And you want people to not pay extra interest, right? You want people to not have to pay more tax than they have to pay and stuff like that, And there's one question that I'm sure you've gotten this before, right? That in terms of what's the difference between a TFSA and an RRSP, and people want to know that what should they be investing in more, and how may that impact them in retirement, like with their pension and okay.
Yeah, it's a common question that we get. Well, and a lot of the problems is that people, even though the tax-free savings account's been around for 12 years, there's still a little bit of a misconception of what it actually is. And the tax-free savings account is not a savings account. It should have been described as a tax-free investment account. So what happens is, your tax-free savings account, you can make contributions in, and you don't get a tax refund, for doing that, making those contributions. But any growth that you get on inside that is tax-free, and that can be a really good retirement tool. As we kind of talk into the RRSP. So with your RRSPs, you make a contribution today, you get a tax refund. So the government says, thank you for taking the time to contribute to your retirement. Here's some tax money back. And in return, you get the tax deferred growth in your RRSPs. But then when you need to take money out, then you take that out. You get taxed when you take it out. So in a situation where, somebody who's, maybe has a pension and, constantly contributing to their RRSPs on a regular basis, at the age of 71, you are forced to take that money out, even if you don't need it. So what that can do is, depending on your situation, that can put you into a higher tax bracket. So today, if you are making more than $79,000 in retirement, your old age security, you have to start paying that back. And so if you were to invest a little bit into, have a diversified portfolio, investing some into RSP, some into tax-free savings account, when you withdraw from your tax-free savings account, it's going to be income to you, but the government's not going to count that as income. And it provides you with a little bit more flexibility in your retirement, and you get to keep a little bit more of the government benefits.
Yeah, so this is actually a lot more complex than people think, right? With what is better? Everyone thinks, oh, just do your RSP for retirement. But what tax bracket are you in now? What tax bracket you probably in the future? And you make a great point with that it should have been called a tax-free investment account. Like I know a lot of people that they think it's just a savings account, so they're there at the bank making 0.5% interest or something like that, right? And you're actually losing money, because the rate of inflation is 1.8% on average per year. So right now, let's say something costs you $100 right now. Well, next year, that's going to at least cost you $102. So if you got $100 in the bank saving for that, and you get 0.5% interest, now next year you only have, what, $100 where's my math on that one, right? But the point is you actually have less money than you have, right? And if you multiply the $100, you talk about thousands or tens of thousands or hundreds of thousands of dollars, right? You are losing money every single year by just having in a savings account. So that's why you need someone like John on your side to look at what you're doing and just think, is this the best approach? How can we get you making more money, paying less interest, paying less tax if that's your situation, and make the most of it, right? So actually, the only time you're really going to get a benefit with a tax-free savings account is when you are making significant growth on your investment. And 0.5% interest in a savings account is not even inflation. So you're not making anything. You're actually losing money every year. So that's why, it's good to work with you, because you're going to go into those details, ask all the right questions, right? And get them to understand too, providing with education, right? And then constructing that overall plan. Let's make that plan. So you are going to get to your goals, right? And then you're not going to end up paying more tax later on, right? Or you are making the most money. And that a lot of people, they don't realize. They think, well, GIC is great, and I should go with that. But it actually is a very, very low, paying investment, and the same thing with you're saying that you're being a broker, you can offer investments from many different companies, right? We're like the bank, and the bank's got some good funds, right? But they have, they're limited. They just sell their own funds. So would you rather just get funds from one source, or would you rather have many, many options to try to get the absolute best that are out there?
Yeah, like our goal is to essentially, provide our clients with education so they can make that informed decision. One recent example was, it's not always about, the banks, right? Like we had, a lot of people, they're going to their virtual brokers now, or virtual investors, such as, Wealthsimple. And, we're having that conversation with the client. We put together a portfolio. We provided her with some recommendations. The fees were under 2%, which were good. And she was like, well, why would I go with you when I could go to Wealthsimple and only pay 0.4%? And I said, well, it's a little bit more of a misleading statement, because the Wealthsimple, they do a lot of EFTs, and they have their own management fees that are included in that. So what happened was, there were some hidden fees that she wasn't aware of. And, we've just provided her with that education, and, made some recommendations on how to structure her RRSPs and tax-free savings account portfolio to make sure that she's getting the best, saving on taxes, which really provided a lot more valuable advice. And yeah, so there are fees in absolutely everything. And it's I guess I'm just trying to get at as well, Simple has their own little fees inside their investment portfolios that are not always calculated into your returns, right? So we just want to provide you with the information, disclose, all the information that we have up front, and describe the value that we can bring to you on with those different service fees.
Exactly. And at the end of the day, though, it's not really even, obviously, you don't want to pay too much, but it's also about your rate of return. So if you're making, even if the person's being charged 2.5% interest, if you're making a, 10% return on your investment, right, that you're coming ahead with like 7.5%, or someone maybe they're paying 1.5%, but if you're only making 5% interest, you're actually walking away with 3.5% growth. So that's another consideration for people to think about. Yeah.
And that's what we take the time to provide the education. So, you have that opportunity to make that really informed decision. And that's the most important thing for me.
Great. Well, thanks so much for coming on, John, today. You are amazing, right? And that's so happy to have you part of our professional network and send you lots of referrals. And, you need to reach out to John. And I believe you're offering a complimentary consultation.
Yeah. So what I can do is I can actually offer a complimentary financial plan. And so I can put a link into there, which, give you that, as well as I can offer a complimentary consultation. So the link should be down below. So please make sure you click.
Great. And let's say someone decides to become your client. They have to pay you another extra fee for your ongoing service?
Everything's all sort of done everything's paid by third parties. So with the insurance recommendations, there's no additional charges for that. And then for the investments, we review that and negotiate on what those are. But you don't get I'm not a lawyer. You don't get a bill for every time you send me an email.
Right, exactly. Yeah, great. They just kind of already built in everything in that. It's the other companies that are paying you. So it's really no risk to the customer, right? Just to come in to have a chat with you, right? And have a plan. So, I think that is great to take advantage of that, getting a custom financial plan done for your own situation, right? By a professional, and that you're in the process of getting your certified financial planner, which is like the highest standards in financial planning. Then reach out to John. So we're going to put your information in the chat, John, with the book of video call for the free financial plan and your email, phone number, and stuff like that. So you have a great weekend, and look forward to seeing you again next week.
Thanks for having me, Tammy. Thank you. Bye-bye.